Investing was never a game of intelligence. Believe me, I've watched brilliant minds, people far smarter than I ever claimed to be, lose everything they had because they were thinking with the wrong framework. The market doesn't reward IQ points. It rewards clarity. And clarity doesn't come from emotion, excitement, or confidence. It comes from the mental models you carry inside your head. Those models are the difference between people who survive decades in the market and those who get carried out on a stretcher when the tide turns. Most people don't realize this. They still think investing is about finding the next big thing, spotting hidden patterns, or being the first to uncover some magical secret. But investing isn't about secrets, it's about judgment. And judgment comes from thinking correctly, especially when everyone around you is losing their mind. I've watched extremely bright people sabotage themselves. They chased every shiny story the market fed them, convinced they were seeing something special. They let excitement take the wheel. They let fear take it back. They reacted to noise as if it were prophecy. And when the dust settled, all they had left were excuses. The truth is simple. Intelligence without discipline becomes a liability. A smart person with the wrong model is a danger to himself. The market is not a kind teacher. It's noisy, chaotic, unpredictable, emotional, and often flat-out absurd. If you try to navigate that chaos with intuition alone, you'll get lost. And when you get lost in the market, you don't just lose your way, you lose your money. That's why mental models matter. They keep your mind anchored when everything else is drifting. When I talk about mental models, I mean the big ideas from psychology, economics, mathematics, biology, history, ideas that help you see reality instead of the fantasy most investors chase. The market is human nature on display. Greed, fear, impatience, envy, denial, those forces haven't changed in thousands of years. And if you don't understand them, if you don't recognize when they're acting on you, you'll become their victim just like everyone else. A solid mental model saves you from yourself. It protects you from getting swept up in a rising tide of euphoria or a collapsing wave of panic. It gives you the discipline to stop, breathe, and ask the only question that matters: what's really happening here? Most people never ask that question. They're too busy chasing what looks good on the surface. They want excitement. They want movement. They want the story everyone's talking about. They want the candy, not the vegetables. But investing is not a candy store. Real investing requires understanding the forces that make businesses thrive or collapse. Incentives, competition, human bias, compounding, durability, weakness. None of this is glamorous. None of it is exciting. But all of it determines your fate far more than any prediction or headline. Without mental models, you become the kind of investor who chases trends, buys what everyone else is buying, sells when everyone else panics, and calls it strategy. With mental models, your thinking changes. You start asking deeper questions. What's the real value here? What assumptions am I making? What can break? What's the long-term reality behind the short-term noise? You don't need hundreds of models, you just need a few dozen good ones, used consistently and honestly. The market punishes inconsistency. It punishes impatience. It punishes people who think in straight lines, who believe the future will behave like the past, who imagine they can outsmart millions of other players by simply guessing faster. The market is full of people who want shortcuts, and shortcuts in investing usually lead to cliffs. When you build strong mental models, the market stops surprising you. You understand why bubbles form, why they burst, why people make the same dumb mistakes again and again. You understand why patience pays. You understand why hype destroys more fortunes than crashes ever will. Mental models keep you humble. They remind you that your vision is limited, your knowledge incomplete, and your emotions unreliable. That humility saves you from disaster. Nearly every investment catastrophe I've seen could have been avoided by applying the right mental model at the right moment. But people don't do that. They rely on emotion, prediction, confidence, and wishful thinking. They look at numbers on a screen and believe the numbers tell them everything they need to know. They forget that numbers are meaningless without interpretation. Interpretation is where wisdom lives. Before you try to outsmart the market, upgrade the way you think. Build a better system in your mind. Investing becomes a lot less confusing when you stop reacting emotionally and start relying on a set of principles that reflect how the world actually works. You don't need to be brilliant. You just need to think better than the crowd. And thinking better doesn't come from luck. It comes from building mental models that protect you from the biggest threat to your wealth, your own impulses. And those impulses become far more dangerous when you step outside the boundaries of what you truly understand. That's where the real trouble begins. And that's exactly where the next chapter starts. If there is one idea that protected me more than any other throughout my life, it's the simple truth that you must stay inside your circle of competence. The world rewards people who know what they understand, and punishes those who pretend to understand more than they do. Most investors never learn this. They think confidence is the same as competence. They think enthusiasm is the same as expertise, and then they wonder why the market humbles them. Human beings have an extraordinary ability to lie to themselves. They convince themselves they know enough. They convince themselves they understand an industry after reading a few articles. They convince themselves a business is simple, when in reality it's a maze of hidden risks, incentives, pressures, and dynamics they've never even considered. This self-deception is the first step toward ruin. I learned early on that ignorance in investing isn't just a weakness, it's a danger. The market punishes people who don't respect their own limitations. That's why I chose to live and operate inside a very small circle. I didn't try to be an expert in everything. I didn't chase every shiny new industry that showed up on the front page. I didn't fool myself into thinking I could predict revolutions in technology, energy, or fashion. If something looked confusing, I walked away. If something required brilliance to understand, it wasn't for me. Most people think that means missing out, but missing out is not the enemy. Catastrophic mistakes are the enemy. The world is full of tempting opportunities that look wonderful on the surface, but hide deadly risks underneath. And you can't spot those risks unless you truly understand the arena. You don't need to be a genius to invest well. You just need to be honest. Honest about what you know, and brutally honest about what you don't. Honesty sounds simple, but it's one of the hardest things in the world, because honesty forces you to admit your limits. Honesty forces you to say, I don't know. And those three words are some of the most powerful and profitable words an investor can ever say. I don't know protects you from arrogance. It protects you from speculation. It protects you from walking into places where you don't belong. Most people can't say those words because they're too busy trying to look smart. They think investing is about impressing others with predictions. They think it's about having opinions on everything. But the market does not reward opinions. It rewards restraint. It rewards discipline. It rewards people who are humble enough to avoid playing games they cannot win. Warren and I spent our entire careers refusing to step outside our circle of competence. Other people rushed into complicated industries because the headlines said they were the future. We stayed still. People asked us why we were ignoring emerging technologies that everyone else was chasing. We told them the truth. We didn't understand them. And because we didn't understand them, we had no business touching them. That discipline saved us from countless disasters. While the crowd jumped into whatever trend looked fashionable, we waited. We were in no hurry. We weren't trying to keep up with anyone. We simply looked for the rare opportunities that fell inside our circle. Businesses we could explain in a single sentence. Businesses we could understand as clearly as our own reflection. People don't realize how much trouble they avoid by staying inside their lane. Temptation is everywhere. Stories are everywhere. The market is full of excitement designed to lure you into places where you have no advantage. And the moment you chase something you don't fully understand, you're gambling, not investing. The irony is that staying inside your circle makes life simpler, much simpler. When you stop pretending to know everything, you stop comparing yourself to others. You stop chasing trends. You stop feeling the fear of missing out. You stop caring about what's hot today or what everyone else is talking about. Instead, you build depth where you already have strength. And something interesting happens when you do that. Your decisions become clearer. Your thinking becomes sharper, your emotions become quieter. The noise fades. For the first time, you can see the difference between something that looks exciting and something that actually makes sense. Over time, your circle can grow, but it grows slowly. It grows through real learning, real experience, and real mistakes. Not through wishful thinking, not through headlines, not through pretending. Growth requires effort, but even as your circle expands, it never becomes infinite. There will always be things you don't understand. That's normal. That's healthy. The goal in investing isn't to know everything. The goal is to avoid doing stupid things. And nothing causes stupidity faster than operating outside your competence. That's where the most painful mistakes come from. That's where fortunes disappear overnight. Survival is the foundation of long-term success. People love to talk about making money, doubling money, beating the market, but the truth is simple. You cannot compound wealth if you don't survive long enough to let compounding work. Big mistakes destroy more fortunes than bad markets ever will. And almost every big mistake begins with someone stepping outside the territory they truly understand. That's why the circle of competence matters. It's not about limiting your life, it's about protecting it. It's your shield against panic, hype, and stupidity. It's the fence that keeps you away from the cliffs everyone else is running toward. And yet, even inside your circle, the market will still test you. Because understanding something doesn't protect you from the emotions of the crowd. That's the next danger. And it's far more powerful than most people realize. And that leads directly to the next mental model, the one that exposes just how dangerous the market's emotions really are. If you really want to understand markets, you must first understand the most unpredictable force inside them, human emotion. Numbers don't move themselves, charts don't think, stocks don't rise or fall because of destiny. They move because people move, and people, especially in groups, are wildly inconsistent. That's why one of the most important mental models any investor can learn is the idea of Mr. Market, a lesson I borrowed from my teacher, Benjamin Graham. Imagine you have a business partner who shows up at your door every morning with an offer. Some days he's ecstatic, irrationally happy, euphoric, practically glowing, and he wants to buy your share of the business for a ridiculous price. Other days he's depressed beyond measure, drowning in pessimism, and he begs you to take his shares for next to nothing. He swings between these moods constantly, with no pattern, no logic, no consistency. That partner is the market. Your job is simple. Don't become him. Most investors do exactly the opposite. When Mr. Market gets excited, they get excited. When he panics, they panic. When he jumps into something stupid, they follow him. When he runs out of the room screaming, they don't ask what's burning. They run with him. This is how fortunes disappear. This is how bubbles form. This is how crashes wipe out people who should have known better. The market's emotions are contagious. They infect you slowly, quietly, without your permission. You see others getting rich, and envy whispers that you're falling behind. You see others panicking, and fear whispers that you're next. You start confusing price with truth, as if the market's opinion at this moment is the ultimate measure of reality. But the market doesn't know the truth. The market only knows feelings, and feelings are terrible guides for making financial decisions. One of the biggest mistakes investors make is assuming the market is rational. They imagine prices reflect intelligence. They imagine movements reflect wisdom. But that is not how markets behave. Market prices are emotional thunderstorms. They are unpredictable, temporary, and often ridiculous. I've seen great businesses trade at insane discounts for no reason other than the mood of the crowd. I've seen terrible businesses soar simply because people convinced themselves a fantasy was real. If you allow yourself to mirror the market's moods, you become its servant. And the moment you become its servant, you stop thinking. You start reacting, you start chasing, you start fearing, you start hoping. And hope is not a strategy. Fear is not a strategy. Excitement is not a strategy. Only judgment is. Mr. Market teaches you one essential truth. The market exists to serve you, not to instruct you. His mood swings create opportunities, not commandments. When he's euphoric and offers you foolishly high prices, you're free to sell. When he's depressed and offers you foolishly low prices, you're free to buy. But you are never obligated to act on his emotions. Your advantage comes from staying calm while everyone else loses their mind. Most investors underestimate how important temperament is. People think intelligence wins, but intelligence without emotional control is a disaster waiting to happen. You need a calm mind and a strong spine. You need to tolerate boredom. You need to resist panic. You need to ignore the chaos that pulls everyone else into bad decisions. When prices fall, most people assume something is fundamentally broken, but sometimes prices fall simply because people decided to be scared today. When prices rise, most people assume brilliance is unfolding, but sometimes prices rise because the crowd decided to be optimistic for no reason at all. If you understand that, you stop taking price movements personally. You stop treating them like messages from the universe. You start treating them like what they truly are: noise. One of the greatest mental advantages you can have is the ability to separate the business from the price. The business is the engine. The price is the gossip. The business produces value. The price reflects emotion. And emotion changes faster than reality ever will. If you want to learn discipline, study what happens during extreme market moments. When the crowd is euphoric, they act like nothing can go wrong. That's when danger hides. When the crowd is terrified, they act like nothing can go right. That's when opportunity hides. The crowd is almost always wrong at the extremes. Their emotions distort everything. Your job is to step back and ask, what's actually happening underneath the noise? If you can do that consistently, you will outperform almost everyone, not because you're smarter, but because you're calmer. Calmness is a superpower in markets. When everyone else is drowning in emotion, you're standing on solid ground. That clarity allows you to see opportunities others miss and avoid disasters others willingly run toward. But there's another lesson emotion teaches you, one far more important than recognizing the mood of the crowd. It teaches you something about yourself. It exposes your weaknesses. It reveals the impulses that threaten your judgment. Because the truth is this: the most dangerous emotional force in the market isn't the crowd's emotions. It's your own. Your fear, your greed, your impatience, your envy, your need to be right, your need to act, your need to feel smart. Those forces destroy more wealth than any recession or crisis ever could, and learning to control them is far more difficult and far more important than learning to control your money. Which brings us to the next model, the one that protects you when emotions, noise, and uncertainty converge into something far more destructive. If there is one principle that has saved me and countless other investors from disaster more times than I can count, it's the idea of margin of safety. Most people misunderstand this. They think safety is about avoiding risk entirely. But avoiding risk is impossible. The world is unpredictable. Businesses change, industries collapse, and even the smartest people get blindsided. Safety isn't about removing uncertainty. It's about preparing for it. I've always believed that no matter how much research you do, no matter how confident you feel, no matter how strong the numbers look, you can still be wrong. And if you can be wrong, you must protect yourself from the consequences of being wrong. That's the purpose of a margin of safety. It's the space between what you hope will happen and what you can survive. The market punishes overconfidence brutally. I've watched investors stretch too far, pay too much, leverage too aggressively, and convince themselves their analysis was airtight. When reality proved them wrong, the damage wasn't small. It was catastrophic. A single miscalculation can erase years of gains. One moment of arrogance can undo a decade of discipline. A margin of safety prevents that. It gives you room to be human. Because humans aren't perfect. We make mistakes. We misread information. We overlook details. We assume trends will continue even when they're doomed to reverse. Life will surprise you, and most surprises are unpleasant. So you build a cushion, a buffer, a layer of protection that absorbs impact. Think of a bridge. If a bridge is designed to hold 10,000 pounds, you don't load it with 10,000 pounds and hope for the best. You build it to hold 30,000. You give it a margin because you don't want a single, unexpected force to bring the whole thing down. Investing works the same way. You need room for error, your error, the world's error, the market's error. When Warren and I bought businesses, we looked for qualities that added safety long before we looked for upside: strong balance sheets, durable advantages, honest management, predictable economics, and most importantly, a price that already offered protection. If we were wrong about the growth rate or the future prospects, we didn't want to lose the farm. We wanted companies that could endure trouble, not companies that required perfection. People underestimate how fragile the world can be. Technology shifts, regulations change, competitors innovate, lawsuits appear out of nowhere, scandals erupt, leadership fails. Nothing stays good without effort, and nothing stays predictable for long. If you buy something that only works in perfect conditions, you are setting yourself up for ruin. The market rewards durability, not drama. It rewards those who survive long enough to let compounding work. Compounding is a miracle, but it's a miracle that demands time. And you can't get time if you blow yourself up every few years chasing excitement or stretching for returns. A margin of safety keeps you in the game, and staying in the game is how you win the game. Most investors don't think this way. They want maximum return, maximum excitement, maximum action. They prize speed over endurance. They want to swing for the fences, but swinging for the fences is how most people strike out. In investing, you don't need home runs. You need to avoid disasters. A single disaster can wipe out decades of discipline. A margin of safety is humility in action. It's the acknowledgement that you are not infallible. It's the recognition that the world is messy and unpredictable. It's the courage to aim for survival instead of glory. And ironically, survival often leads to more glory than heroism ever could. One of the quiet truths of investing is that durability almost always outperforms brilliance. The investor who avoids big mistakes will beat the investor with big wins, because the big wins rarely last, but the big mistakes almost always sting. And the pain from a mistake compounds faster than the gain from a victory. But margin of safety is more than a financial model. It's a mental model. It extends beyond numbers and portfolios into the way you live, think, and react. You build a margin into your judgment so you're not dependent on perfect timing. You build a margin into your expectations so you're not destroyed by disappointment. You build a margin into your emotions so you don't fall apart when uncertainty rises. Because uncertainty is guaranteed. Panic is guaranteed. Irrationality is guaranteed. But ruin is not, if you prepare for it. If you leave yourself no room for error, the world will eventually teach you the cost of that arrogance. And it usually teaches the lesson when you can least afford it. What most people don't realize is that the margin of safety becomes even more powerful when paired with another mental model, one that determines where your attention should go, how you judge opportunities, and how you decide between good and better. It's the model that explains why doing nothing is often smarter than doing something. It's the model that determines how you allocate your limited time, your limited money, and your limited judgment. It's the model that reveals why even a good investment can secretly be a terrible choice. And this idea is the key that separates disciplined investors from restless ones. Opportunity cost is one of the most important ideas an investor can ever learn. Yet it's the one most people ignore. Most investors look at an opportunity and ask, will this make money? But that's the wrong question. The real question, the only one that matters is this the best possible use of my time, my capital, and my attention compared to everything else I could be doing? Every decision you make has a hidden price. That price is whatever you give up by choosing something else. Most people never consider that. They get seduced by investments that look decent, look promising, look exciting. But decent opportunities are dangerous because they block you from seeing the exceptional ones. A mediocre investment doesn't just sit in your portfolio, it steals space from something better. Warren and I avoided thousands of opportunities over the decades, not because those investments were terrible, but because they weren't good enough. They didn't justify our capital. They didn't justify our time. They didn't justify the attention they would require. Opportunity cost taught us discipline. It taught us to say no far more often than yes. And that discipline, more than intelligence or prediction, built Berkshire Hathaway. Opportunity cost forces you to raise your standards. It forces you to stop chasing everything that moves. It forces you to stop treating activity as progress. The market loves activity. Brokers love activity. Commentators love activity. But activity destroys investors who don't understand its cost. Every trade you make, every hour you spend researching something you barely understand, every moment you spend reacting to the crowd, it all comes at the expense of something else. Time is finite. Capital is finite. Judgment is finite. And when you waste those resources on things that don't truly matter, you pay the price in lost opportunities you never even saw. This idea also protects you from emotional traps. When the crowd is excited, everything looks irresistible. When the crowd is fearful, everything looks dangerous. But when you think in terms of opportunity cost, you stop asking, is this good? And you start asking, is this better than my alternatives? That one shift cuts through hype, panic, trend chasing, and noise. It puts your focus exactly where it belongs, on rational allocation. Most people think in absolutes. Smart investors think in relatives. A rising stock isn't necessarily good. A falling stock isn't necessarily bad. The real question is whether an opportunity deserves a place in your portfolio compared to what else is available. If something offers uncertainty, low returns, or weak long-term prospects, it doesn't matter how exciting the story is, it fails the test. Understanding opportunity cost makes your thinking sharper. It makes your decisions quieter. It frees you from the pressure to act constantly. And over a lifetime, that mindset produces far better results than any brilliant prediction ever will. But there is another model, one that goes even deeper, one that explains why the biggest disasters and the biggest successes in markets rarely have a single cause. People love simple stories. They want to believe one factor created a boom or caused a crash. But the truth is far messier. Big outcomes come from multiple forces acting together, reinforcing one another until they create something extreme. That's the idea behind what I call the Lollapalooza effect. When several psychological, economic, and emotional forces combine in the same direction, outcomes become explosive, far more extreme than logic alone would predict. Bubbles don't form because of one factor. They form because rising prices fuel greed, greed fuels social proof fuels envy fuels leverage fuels risk-taking, and risk-taking fuels even higher prices. Each force strengthens the others. Momentum feeds momentum, and the crowd becomes blind. That's a Lollapalooza. The same happens during crashes. Fear triggers selling. Selling triggers more fear. Leverage unwinds. Bad news piles up. Confidence collapses. Prices don't fall, they plunge. People don't sell, they panic. Once again, many forces work together to create an outcome far worse than any single variable could cause. Most investors never see these forces coming because they think too narrowly. They look at one factor, one headline, one number, but the world is multi-layered. Markets are multi-layered. Human behavior is multi-layered. A narrow mind is a dangerous mind in this business. And the Lollapalooza effect doesn't just explain disasters, it explains spectacular success. When a company combines great management, strong incentives, customer loyalty, efficient scale, and network effects, the result can be unstoppable. Each advantage reinforces the others. Each victory amplifies the next. Before long, the company becomes a force of nature. Recognizing these patterns requires broad thinking. You cannot rely on a single model. You need many. You need psychology to understand investors. You need economics to understand incentives. You need history to understand cycles. You need biology to understand competition. You need mathematics to understand compounding. No single model is enough. But together they form a latticework, a network of ideas far stronger than any one of them alone. That latticework protects you from blind spots. It exposes your illusions. It challenges your assumptions. It forces you to view reality through multiple lenses, revealing truths the crowd will never notice. And once you see the world that way, you will never again be confused by markets. The ambitious young investor always looks for some trick, some shortcut, some formula to guarantee success. But the real advantage, the one that separates the exceptional from the ordinary, comes from building a mind that stays calm when others panic, patient when others rush, skeptical when others believe, and clear when others are clouded by noise. If you build that mind, success becomes less a matter of luck and more a matter of inevitability. Not because you're smarter, but because you're consistent, because you avoid disasters, because you wait for real opportunities, because you think better than most people ever will. In the end, investing isn't about brilliance. It's about judgment. It's about temperament. It's about holding yourself together when the world falls apart. And those who master that win a game most people don't even understand. It's the model of opportunity cost. And once you understand it, everything about your decisions changes.